Dustin, good to see you. Today we are tackling the age-old question, should I pay off my mortgage early or invest? Let's say someone has a pile of cash sitting in the bank right now. Perhaps they're invested in a money market account earning 5%. Let's talk through whether those safe returns have changed the conventional wisdom when it comes to paying down your mortgage. And first, you say you need to ask yourself if you need the liquidity.
Sure. Liquidity is an important question. Another question you want to ask is, hey, do you want to be in a position where you ask permission to access or spend your money? So, when you keep in mind, when you take liquid assets and you use those liquid assets to pay off your house, convert those liquid assets into home equity. In order to access that money again, you're going to have to do one of two things. You're either going to need a new loan or you're going to need to sell that house again. And if it means a new loan, something like a line of credit, understand you've got to get permission. You got to get other people involved to do that. You've got to qualify for that loan. Okay. And also keep in mind that there is no guarantee that that home equity line of credit will be an available option. If we think back to the pandemic, I know at least Wells Fargo and Chase stopped offering home equity lines of credit for a period of time.
Yeah, I don't want to put yourself in a bind. Next, you say you need to determine how the returns compare. Compare the ROI of a mortgage paydown versus investing in the market.
And I would say what we want to pay attention to is the real rate of return. So we can look at some very simple math. If right now you're earning, let's say 5% in a money market account or 5% in a high yield savings account, and if we assume a 3% inflation rate, even though we're running a little hotter than that right now, if we assume 3% inflation, we are not really earning 5% as a real return net of inflation. You're earning 2% as a real return. Okay. Now we can look at the flip side of that when it comes to debt or servicing debt. If we've got one of those older mortgages, let's say at a 3% rate, and we assume a 3% inflation rate, well, our real cost of interest isn't 3%, it's zero. I don't know about others, but in that case, that's a mortgage that I would never pay off early. Okay. I'd ride the bank. But if we're talking about a newer mortgage at 7 or 8%, that may change the calculation some. I would tell you in many cases, however, the considerations of liquidity and control of that money, in many cases, are still going to be bigger and more important considerations than the interest rates.
All right. Next, you say you need to determine, is inflation working for or against you?
Sure. We can look at some examples here. So if we talk about a mortgage payment, in this case, let's look at a $2,000 a month monthly principal and interest payment. Important to remember, if you pay off a mortgage, you're not getting rid of the entire mortgage payment or your housing cost. You're getting rid of the principal and interest payments. Still got taxes, still got insurance, still got maintenance and repairs, right? But the cost of that monthly payment, that monthly principal and interest payment, it doesn't go up over time with inflation like other things do. It remains flat. So what that actually means is, in real terms, after inflation, that payment gets cheaper as time goes on.
Right.
Value of the dollar goes down, you get raises, becomes a smaller portion of your budget. So it's important to understand that if you work really hard over a number of years to get that paid off early, you're not really freeing up the same sum. So in this example, if you had a 30-year mortgage and you paid it off 15 years early, 15 years from now, you'd free up $2,000 a month. But at a 3% inflation rate, at that point, that $2,000 will only purchase about $1,200 worth of goods and services. Okay. And these days we're talking about something closer to approaching a car payment than a home mortgage. On the flip side of that, if we look at our equity position, let's say we paid off a $400,000 home. So now we've got an asset on paper, $400,000 in equity. It's important to remember, however, not only is that asset not easily accessible, but that asset doesn't generate any kind of return. It doesn't earn any interest. It doesn't earn any dividends. Okay. Now we would expect over time that $400,000 house to go up in value, but that increase in value is something you're going to get whether you have a mortgage or whether you don't. Okay. So if we were to look at selling that house, for example, 15 years down the road, and we look at that original $400,000 in equity, not the equity that the market gives you in price increases, but just that original $400,000, because it didn't earn any return 15 years from now, when you sell that house and you harvest that $400,000, it's got a purchasing a value of approximately $250,000. It would buy about $250,000 worth of goods and services. So keep in mind, when you're servicing a mortgage, inflation works for you as a borrower, and it actually works against your equity position.
Hmm. And the last question you need to ask yourself is paying off your mortgage going to bring peace of mind? I mean, the spreadsheet may say something, but our heart may say something else.
Right. There's a lot of emotion around these
Yeah.
decisions. That's been my experience. So by all means, you want to make the decision that allows you to sleep well at night. I would
Mhm.
just say, before you make these decisions, make sure you understand the risk of paying off a mortgage early, the cost of that, and the alternatives.
Hmm. So clearly, Dustin, this warrants a conversation. There is no cookie cutter answer. If somebody wants to crunch the numbers and talk it through with you, how can they reach you?
They can text me a question at 830-476-2505 or reach out on the website to book a free chat at longlivemymoney.com.
Great. Dustin, thank you.
Thanks, Aaron.